I definitely think that the market is testing the MicroStrategy thesis.
If you look at this drop, right, it dumps and it's continued to dump since they sold.
If you look at the options market, what is being priced right now is first, there is demand for MSTR, but there's definitely no panic. No, oh, let's get out of the door. Let's price some sort of uninterrupted crisis at the MSTR level.
Is strategy rebranding from a leveraged Bitcoin proxy to a Bitcoin backed credit issuer? What do you think the yield will have to be on stretch for it to hit par again?
There was a sale this week and they built cash reserves and bought Bitcoin. Should they buy stretch to bring it back to par? Nothing said on inflection point is a recommendation to buy or sell securities, tokens, or any other assets, nor does it constitute a solicitation or offer to invest in any fund, product, or financial instrument. This podcast is for informational purposes only. The views and opinions expressed by hosts and guests are their own and do not necessarily reflect the official positions or views of their respective employers or affiliates. Hosts and guests may hold positions in companies, funds, tokens, or projects discussed. Everyone, welcome back to Inflection Point. I'm joined as always by Michael, Marc Antonio, and David Lawant. Guys, how are we feeling?
How's it going? World Cup going full steam. I'm happy.
The vibes are so good in the United States right now from this World Cup. I mean, I'm going to be I'm going to have like seasonal depression when it ends. I want this World Cup to go on forever. Just the amount of, I don't know if you guys have been following this, but the amount of positive news and virality of Europeans coming to the United States and Japanese and South Koreans coming to the United States and just loving America is just so nice to see. And it makes me proud to be an American, but also it makes me realize how close we are with our fellow humans throughout the world. And if it wasn't for our, one could say, corrupt or self-interested politicians globally, not just the United States, but globally, I think most of the world's issues could be worked out through sports.
Yeah, I'm really getting that vibe as well. This is what the World Cup is supposed to be about, minus the corruption of also FIFA. But this is what the World Cup is supposed to be about, and I love it. I love seeing the videos. There was one of the Japanese fans after the game cleaning up the stadium. They brought their own trash bags, and then what was really funny was that we in the West love satire, so somebody posted that video but in reverse, making it look like they were polluting the stadium, and then that became viral in Japan, and they didn't get the joke, and they became kind of upset. So it was kind of like a culture mismatch, but also funny and also very sweet. I mean, that's typical Japanese, yeah.
No, I love it. And it's about to get more exciting, right? We're now in the final round of the group stage, and now we're gonna get into the win or go home matches, and it's going to get more and more exciting. I think we're going to see some very big games. For those who cannot see it, I'm wearing my Brazil black on black jersey.
There we go.
Still number 3 jersey that Nike makes. They don't use it on games, but yeah, it's more discreet. So I thought it was a good one to wear today.
I like it. I do think the World Cup is somewhat relevant to crypto in the sense that crypto has always been a global movement, and it has always been uniting people from all around the world through decentralized mechanisms. And the World Cup, I think, just shows that as technology advances and the world becomes smaller, you're going to need to shift from national rails to global infrastructure. And I do think that one noteworthy story is that Polymarket is doing quite well on the betting for World Cup, much better than typical sports betting, which is usually dominated by Kalshi. And some viewers and some observers link this to the fact that Polymarket is more of an international brand than Kalshi, which is more of a US brand.
Yeah.
So I think that's just very interesting. And I think that the World Cup is definitely improving the image of the United States globally. And I think we're, with that, I think institutions really need to take a hard look at crypto and reflect that this could be the best possible technology to expand U.S. reach throughout the world.
It's funny that you brought that up, Michael. I actually have this chart here. This is it's unlabeled, but this is the breakdown of Polymarket's open interest by category. Can you guess which one the pink is?
I would have to say it would be FIFA World Cup.
It's sports betting. It's
yeah.
mostly sports betting. It's dominating the platform right now. So it's a more crypto than we even thought. Sorry, David.
So the biggest one is sports.
Yes.
Is the second one crypto?
The second one, let me just double check before I say anything wrong here. The second one is,
I know these like 1 day, 5-minute crypto markets are huge on Polymarket.
It's actually politics.
Wow.
Politics. Okay, yeah, no, that makes sense.
The third one in gray is crypto. So yeah.
Oh, okay, yeah. Okay.
And then I'm measuring it by open interest, but then there's also volume, which I don't really like as much because you can fake volumes, but volumes it's even starker. But then crypto becomes second place in the volumes. So yeah.
Wow. Yeah, I mean, so what explains that? I mean, as far as I know, Kalshi has always been more of a hub for sports betting, prediction markets for sports. The fact that World Cup comes to town and Polymarket is taking off, I think reflects the fact that the global audience is turning to Polymarket first. And that's probably in part because it's easier to trade on Polymarket for international traders than it is Kalshi.
Yeah.
Is it just me? Is it just me or all of your friends now suddenly sports gamblers as well?
Oh yeah.
100%. I have to say that in Brazil, it's the world. There's always been a lot of gambling around the World Cup. It's just now a lot more organized, I think, because now you can make. So in Brazil, they used to make these bolões, which was were actually very, very well organized, but kind of over the counter informal markets that got really, really big, especially during the World Cup. Now, I think prediction markets are making these a lot smoother and more efficient.
I mean, I think this is a trend that is broader than just sports betting. And give me a second to explain this. So, sports betting historically was confined to local communities, right? Local bookies. And the market was opaque and it was less liquid. When you globalize those localized markets historically, you get better liquidity, you get better pricing, you get more fair markets. This is obvious for sports betting, but it's also equally obvious for a host of other markets that have yet to really see a similar shift, but I think over time will. So, for example, you have pawn shops all throughout the United States where people go to borrow against their belongings, their assets, or to sell their assets, right? You, you could easily have a global pawn shop, if you will, where you need a short-term loan. You have a nice watch. You can go to a bank and try to get borrow against the bank. But again, even with the bank, you're still in this sort of you're in this localized small market. You instead could tokenize the watch. You could borrow against it online on a blockchain and have the entire global liquidity pool, liquidity supply actually compete to provide liquidity, to provide a loan against that collateral. And you can start to see that for a lot of things that big institutions and high finance they kind of overlook, right? Like pawn shops and small retail loans doesn't seem to be like a huge piece of anyone takes up a huge piece of anyone's mind share. But that's how really interesting new markets form. They usually form in these small corners of the market and then expand outwards, because in the small corner you have a really inefficient market that once is made efficient, you start to see that you can apply those market structures to a broader class of assets. The best example is how Amazon started as just a bookstore, and now it is this everything store. Um, Spotify started as like a place you go to listen to really esoteric sort of niche music, and now it is where everyone listens to music. Airbnb started as like couch surfing because like there was this niche community of people who like to couch surf. And now it is a huge behemoth. So I do think that the ability to build a global brand and a global business has never been better than it is right now on blockchains.
I like it. You're very philosophical today, Michael. I like it.
Thank you. Thank you. It's got to be the World Cup, just bringing it out of me.
I love it. And anything else going? Sorry, go ahead, David.
No, I was just going to say very strong analogies from Mike today.
Any analogies for us, Michael, in the markets? Anything you're seeing there?
I'm really focused on South Korea and the dump that it took yesterday or last night. And what that says about, is it just a local phenomenon that's taking place in South Korea, or is this a broader market impact? And is this going to change the dynamics? I believe that when the news first broke, I got it like 2 a.m. last night. South Korea was dumping hard on fear that chip stocks had been overbought. I said, "Oh man, if that's happening in South Korea, you know, uh, strap in for U.S. markets today." But I haven't really seen much. I mean, there's been a little bleeding, but it hasn't been nearly as bad as what we saw in South Korea. So, I've been looking at that, and I'm trying to really surmise. And I don't think anyone really has a good answer to this. Like, what is the trajectory in the short term of the AI markets, or some would say AI bubble, and how that's going to impact crypto markets in the short term?
Yeah, definitely interesting times. My view on these things is we were talking a little bit about this before we started to record, but the South Korea market is usually very specific. And this is true for crypto. This has been true for NFTs. This is also true for stocks in that country. It is a very speculative market. A lot of assets within there. They trade a little bit like meme coins. And it's a very active market. And I think South Korean stocks have been on a tear for quite a few weeks now, and you kind of have these kind of speculative bubble bursts every once in a while. And also the South Korean market is not as connected to global markets as a lot of the others. So I think it's very important to watch, especially because I think we are seeing some similar behavior here in the US, right, with regards to certain markets and maybe certain sectors. So it's always interesting to see what's going on in other markets. But in terms of contagion risks and things like that, I think it's mostly contained over there. Having that said, we are definitely in a little bit more of a risk-off mood over the past many days, right? I'm sure you guys are following SpaceX stock, which I think IPO'd at 135. It rallied all the way to 200. Last I saw was trading at, I think, 140. So it's been a little bit of an up and down here. So we're seeing a risk-off environment across risk assets that has been translating into crypto. As we record now, Bitcoin is again trying to brush the 60K level. It spent most of the past week in the 63, 64K range. Now it's back a little bit to the 60K level. So we'll see how we go from here. I still feel like it's a range trading type of environment. We're still liking these ups and downs, but still trading within a narrow range. But let's see. I fully agree with you, Mike. Nobody knows what's going on. It's a very uncertain environment. You can actually read that in the options market. The Bitcoin options market has been inversed, meaning that volatility has been higher in the short term than in the long term, more than it has always been than it has been in many years. So the market is pricing a lot of uncertainty in the short term. It's kind of this near term anxiety mood, and you can see that, for example, in the options market. So I don't know, these are obviously very hard environments to read. We'll see where we go.
Yeah, and it's worth noting also that I think the market has cooled off a little bit on the prospect of the Clarity Act passing. I think on Poly Market, it's gone down to about a 43% chance as of today, which is obviously low relative to the last 2 months. Um, I don't, without the Clarity Act passing, the standard uh, goalposts that we have been looking for, and the standard catalyst that we have been looking for, or we have been talking about, goes away. And that could be what is cooling crypto markets as well.
I think we also saw some cooling in the AI crypto markets trades, like Nair and some of the other AI associated VVV, even though Venice ramped up again when Fable Mythos was banned. But there's there's this question, AI has been sucking liquidity out. I don't think that's a question. How much of that liquidity has it sucked out from crypto? I think that's uncertain. And then if AI starts to crack, if the bubble starts to pop, I don't know if I would, I don't know. I don't like calling things bubbles, even though technically they are, but anyway. But
Frenzy.
how much is it going to benefit crypto? That's the real question, because people are saying it's, let's look at the accounting of AI. We saw that, I think it was Uber spent their entire AI budget in the first 4 months, and some companies spent $500 million already for the year. And then I think there's this narrative going around that, oh, actually AI is more expensive than humans, right? Which was the
Yeah.
reverse narrative, what we were told in the past few years. And so, I mean, and you brought up, Michael, examples of Uber, and I mean, Airbnb used to be couchsurfing. Those stuff got successful because they were subsidized by VCs and then entrenched, and then we're starting to see the same thing here. But because the financials, like the GPUs that these companies are buying, they're amortized over 5 to 7 years, whereas the capex that some of, like, Nvidia gets is recognized as revenue now. So there's like a duration mismatch in between that, and so there's pressure for these from the VCs, from investors, to stop this subsidizing more quickly than we saw with the Ubers and the Airbnbs of the world, and that's just becoming a little bit more in front of light, so to speak. And I think it's really going to be, I think a good marker will be how and if the Anthropic and OpenAI APOs perform this year. I think that will be a good marker where we are in this AI, let's just call it, life cycle.
Yeah, did you see the news last week about OpenAI's balance sheet was leaked, or their cash flows? And surprise, they're losing money. I think everyone knew that, but seeing it actually, I think, did raise some questions. I'm not particularly worried about that as much, because they're bleeding cash, but at the same time, they feel like they need to keep sinking money into GPUs and on compute in order to keep up. Because I think what's worse than not making money for OpenAI is not being able to keep up with Anthropic's models, or God forbid, a Chinese model. I just saw that Japan has now entered the AI race with a recent model. Um, I think, once you lose the narrative that your model is just so far behind Anthropics or OpenAI, you sort of take a big hit in public perception and usage, right? So there was a time when everyone talked about the big three: Anthropic, OpenAI, and Google. And lately, people have been sort of saying Google's just not not even close to Anthropic right now. And when that happens, I never count Google out, but it does seem like Anthropic is taking a big lead here, which obviously, when you compound that with the fact that OpenAI doesn't seem to be managing its balance sheet as well as some would have hoped, I think it's a big question.
Yeah, these are all excellent points. I saw someone speaking this week and saying something a little bit along these lines, Michael, saying that the AI trade until now has been about finding the next bottleneck, right? So it was first models and then compute and then memory or energy. And I think it was an interesting observation that this trade is probably now coming to an end. And now the main thing that people will start looking for is who has traction, who has an enduring moat, which are the companies that will be around for the long run here. And this is a hard question to answer right now, right? When your capex bill is running at tens of billions, if not hundreds of billions of dollars, you don't give yourself too much room for error. So yeah, it's going to be very interesting. It does feel like right now Anthropic is on the lead. It also does feel like a lot of the companies are becoming a lot much more aware of their AI and token budgets. So yeah, things seem to be changing. But the thing that for crypto has been calling my attention is that I do see a lot of folks starting to delineate what the next crypto bull cycle could look like. And I think it makes sense. It's obviously very early, so we're in kind of very broad brush territory here for now, but it does feel like there's going to be a time, and this is nothing against AI as a technology. AI as a technology is obviously very real and it's going to be around, but these investment cycles, they tend to run a little bit ahead of themselves, right? So stock valuations also can run a little bit ahead of themselves. So whenever that crash happens, so Mark, the word I'm using instead of what was kind of more of a frenzy. We saw that in the dot-com bubble, right? The internet was very real. That didn't preclude the market from attributing insane valuations to a bunch of companies misallocating capital, raising too much capital, and wasting a lot of that. So we might see something similar here in the AI race. It doesn't mean that technology is not going to be around. It of course will, but we can have these kind of Carlota Perez cycles. For those who read that book, Financial, oh man, I forgot the name of the book now. The financial technology cycles. And it feels like this will probably be the time when, especially Bitcoin, will start to emerge again as a topic of interest. It does feel like right now we are not in scarcity territory, right? Everybody's like just thinking about the infinite and about pushing these technologies to the limit. But the world always has a way of imposing scarcity to us, and this can come in a number of ways. Including financial adjustments here. And I think these are the times maybe when we'll start remembering Bitcoin again. I see Piero Chard, Arthur Hayes, I think even some of the folks from Blockworks kind of mentioning that maybe when we start to see this AI peak, we'll see how things go, but maybe attention will start shifting at least to these scarcity denominated assets, right? So like the cash flow generating assets, the hyperliquids of the world, this is probably a different story. But yeah, I'm very interested in seeing, and I do think that the next narrative is going to be somewhere around that. And we're probably 6 to 9 months away from it. I don't want to call it too early, but that's how it's feeling like for me.
That's in line. That's in line with where the 4-year cycle has us as well. I think Q4 this year, the 4-year cycle has up only from then on. And I mean, I was one of those individuals saying, "Oh, the 4-year cycle is dead. We have ETFs now. We have external factors." And I was looking at the data, and actually, into when it becomes out when Bitcoin price is going up, the ETF flows tend to like match, just like slightly behind. And when Bitcoin prices are going down, the ETFs are actually lagging even further. So they're adding more sell pressure to Bitcoin's price. So ETFs haven't I mean, but that's just the net outflows in that period of time. Obviously, there are some ETF investors who hold for the long term, but ETFs in this downturn haven't actually cushioned the blanket as much as I thought it would have prior to their launch. But again, ETFs are what, 2 years old now. Bitcoin's 18, so I think there's going to take some time for even the ETFs like behaviors to mature as well.
And I would say that makes sense, right? Because if you think about where would the AI capital drain effect impact crypto the most, it would probably be in the ETF complex, right? So these are the folks who already have their Schwab or E-Trade accounts, and they're just selling their IBIT to enter into the SpaceX or whatever the new shiny thing is. I feel like let's say the non-crypto native crowd is a lot more impacted by that. In the more crypto native side, I honestly feel like a lot of the selling has already happened. Of course, there's always more potential to come. But I think that's where the new kind of wave of selling is coming from, this more mainstream audience that is probably moving from Bitcoin, from crypto into the new shiny thing. This is a cycle, right? We're in and out of favor. Now we're out of favor. It's happened in the past, and I'm sure it's going to come back.
So, speaking of out of favor and Bitcoin, I'm going to pull up a chart here and show you strategies, preferred share, year-to-date performance. Some one blip in Feb, but pretty stable, and then recently it's just been a massive downturn. I mean, obviously there's some concerns over, I don't know, strategies, liquidity, about it being Terra Luna 2.0. A lot of people in crypto, and I mean, for the record, this product is 80% held by retail. So these aren't necessarily all by long-term investors. I just want my yield. I'm adding it as a small part of a income generating portfolio. I think it's more of a reactionary base. And I think this is what prompted Strategy's last move. I think it was last week or either yesterday. Strategy actually, did their at the money market offering for common shareholders, MSTR. And instead of using all of those funds to purchase Bitcoin, they actually took about 350 mil, something around there, of cash and added that to their reserves, to kind of help, I don't know, alleviate some of the fears of their reducing cash balance. And so now, since that latest sale, they actually have closer to 10 months of dividend coverage. I mean, a few months ago, this was over 2 years. So, I mean, even 10 months is less than half, but I think it was a good move from Strategy. I think they maybe realized that like repurchasing their convertible debt this early at this timing with this new stretch product was possibly a mistake. And I mean, Saylor isn't infallible. We all make mistakes, and I think they're realizing that. And I think right now they're building up their cash position while also still buying Bitcoin on the side. I mean, I think their last purchase wasn't that much, a couple hundred mil, but it still shows that they still have that longer goal of not being a net seller of Bitcoin, still increasing the Bitcoin per yield, and then adding to that cash balance to alleviate some of the fears, while also having sold Bitcoin so far twice in its life cycle, which can also help with the credit rating agencies. And as Michael Saylor said, to inoculate the market. What are you guys thinking about this product? I know Michael, are you still not a fan?
We'll go back to the previous slide.
Okay.
So, like, if you look at this drop, right, it's right around May 26 when they sold, right? They're or June 1st, even when they disclosed that they sold their 32 Bitcoin. Now, let's just put some pieces together here. So it dumps, and it's continued to dump since they sold. Now they've bought back Bitcoin since then, but it did in fact dump, and it's not recovered. You just said, Mark, that majority of holders of MicroStrategy are retail. Of Stretch. Okay. And retail, they, in my judgment, care a lot about the narrative, and any inconsistencies to the narrative that Saylor has been very eloquently promoting for, since 2020, 2021. Any inconsistencies there, I think, are going to be particularly impacted on the retail side. So my view is that retail sort of sold because they feel like any sales from MicroStrategy are a total violation of the sort of pact that he had, he had signed with the public, that that strategy was going to be an accumulation vehicle only, and not a selling vehicle. Now, in fairness, that might not be totally uh, the most fair take to Saylor. It might not be. And you can sell Bitcoin. We've already talked about this on this pod, but you can sell Bitcoin in order to accumulate more Bitcoin. I get all of that. But again, I haven't seen, and I'd love to hear what David thinks, but I have not seen a real full court press narrative shift from Saylor clarifying their decision and doing a good job of cleaning that mess up that had happened at the beginning of June.
Yeah, I definitely think that the market is testing the MicroStrategy thesis as it's probably have never before. I would say a few things about this. Number one, Mark, your chart is very clear. When Stretch is trading at $87, what the market is saying is that we don't want an 11.5% coupon rate or an 11.5% interest rate to hold Stretch. The number is probably more like 12.5 to 13%, right? So that's exactly what it means to see Stretch trading at the 87 or below 90 level that we're seeing here. The interesting thing, and I brought this already in previous episodes, is that SATA, which is a similar instrument issued by Strive, is actually trading very close to par. It's at 96 or 97. Not at par, but it's also not that far. And if you look at Strive's Bitcoin reserves as a percentage of the amount of perpetual preferred that they're issued, that number is a lot smaller than MicroStrategy's. So I think you can argue that there might be something specific happening with MicroStrategy here, because the spread between the yield that investors are asking for Stretch versus the yield that investors are asking for SATA, which I would argue is riskier and should be higher, this is actually a very narrow spread. So it does seem like there's something specific to Stretch happening here, and this thing is probably what Michael just said, right? So this is probably a little bit of a retail exodus. I think that maybe a lot of folks bought Stretch without knowing exactly what they were buying, and maybe they get scared with the volatility. I think it's dangerous to think of Stretch as a stable coin. This is an instrument that doesn't have a peg. It can oscillate as it has been oscillating, and maybe this has scared a little bit of that, especially retail audience. I've also heard, especially on Twitter, and I don't know to what extent this is true, that there has been a bunch of levered products built on top of Stretch. So again, it's this idea that Stretch is a stable coin and that you can build a leveraged kind of structured product on top of Stretch. And then whenever we have these volatility dislocations, some of these trades get to unwind. So it's probably a combination of these things. I think it's a transition. I do think that Stretch will normalize, but I agree that right now there's probably a little bit of an exodus happening on the retail side. So that's one thing on Stretch. The other thing I've been looking at is what folks are pricing for MicroStrategy itself, because in theory, MSTR equity, right, which is the actual amplification mechanism, right? So this is the lower priority place in the stack. This is where you're going to reap most of the benefits if the MicroStrategy does well and if the Bitcoin prices go up. But this is where we're probably going to endure most of the pain when the reverse is true, which is the case right now. right? So that's why we're seeing MSTR equity trading now, I think, at 1.1 NAV or something like that. And the interesting thing about MSTR equity is that they actually have a very active options market. MSTR is probably a top 20 options market in the US in terms of activity. So there's a lot of signals that you can extract from that. One that I was paying attention to is the risk reversal at the wings, which is basically just trying to see how much asymmetric downside the market is pricing. So basically, what you do here is you look at very out of the money, right? Very far from the current price options, and you see how expensive the puts are versus the calls, and that will give you an idea of how much investors are willing to hedge their downside versus how much they're willing to bet on a symmetric upside. And that's kind of a little bit of a risk metric just to try to see how much of actual tail risk is being implied in the market. And if you look at that number, what you're going to see is that what MSTR, the MSTR options market is pricing is it's definitely pricing downside hatch. So I mean, this ratio is like 10 volatility points higher than it used to be. So it definitely has expanded, meaning puts are more expensive than calls versus there used to be. So the market is pricing downside protection, is willing to pay for downside protection on MSTR, but it's pricing this let's say premium at a much lower ratio than it used to in all the other Bitcoin corrections. Is actually less than half of it. So this is all to say that if you look at the options market, what is being priced right now is first, there is demand for MSTR, but there's definitely no panic. No, oh, let's get out of the door. Let's price some sort of like an interrupted crisis at the MSTR level. And given that MSTR is the most I would say exposed, or probably the part of the capital stack here that will bear most of the grunt, I think that's actually a good signal that things will eventually normalize. Of course, we don't know when that's going to happen. Stretch is trading an insane amount. I think Stretch has been trading multiple hundreds of millions of dollars a day, which is an insane amount for a perpetual preferred instrument. So we just don't know how much of that transition has already happened. Once MicroStrategy announced the 8K that Mark mentioned and increased their fiat reserves by $300 million, I think at that point, Stretch was trading at the low 80s range, and now it's in the high 80s. So it has already recovered some of that confidence in the market. We'll see what else is needed. We'll see how many more folks need to leave. But I still believe that it's definitely a market that is in dislocation, but that it will eventually normalize.
Yeah. I mean, I'm very interested in the identity shift that MicroStrategy is taking from, when they first sold the Bitcoin, right? I think it was on June 1st. Saylor's remarks were, "Our goal is to make Stretch the best credit instrument in the world." That was like his first comment after selling the Bitcoin. And he highlighted the preferred, not the Bitcoin. So is Strategy rebranding from a leveraged Bitcoin proxy to a Bitcoin backed credit issuer? Right. That's my big question. And if it is, I'm curious to know, Mark and David, why that would be the case. Why they would think that a Bitcoin backed credit issuer would be better than a Bitcoin accumulation vehicle.
That's a good. I actually, I wanted to make a comment to David, and I was going to say that I don't. I'm a dichotomy between there's a market pricing these things. The market is saying we have higher yields. It's competing products that are closer to par, and they have, so it shows proof of that. But then also on the other end, and I don't know how correct this is to assume, but given that the majority of the holder base, 80%, according to the CEO as of last week, retail, then how much of these calculations are actually being done? Is this like an official capital allocation? I'm going to lean towards no. And then on top of it, we have these on-chain products, David, that you mentioned, that add additional leverage. And I'm going to assume, again, that is retail doing that as well. And some on-chain analytics lean towards that. From the marketing perspective, here's what I didn't like, Michael, about Stretch. They kind of made it seem like it was a savings product, and this is my interpretation of it, right? And even on the website right now, it still reads as though it's a savings product, right? And you think something is safe, and then because you read it as such, and then after it has this volatility, and then of course you're going to exit it because you have no idea what's going on. Maybe you feel you've been lied to, you didn't understand how the instrument worked. And would I like them, and then to your final point, Michael, would I like them to become like a credit issuer of BTC? I think what I want is not that, but an element of that. And what I mean is, we've talked about on the show a few times that strategy has many levers to pull. And I think that this should just be one of the levers, not necessarily what maybe Michael Saylor is saying as their flagship product. Maybe that shouldn't be it. I mean, MSTR probably should be. Um, but I would like to see it as many levers, and one of the levers I think that they need to have on top of it is selling puts, because my strategy is a buyer of BTC at any price. They say they don't try to time the market, they just try to be consistent. So if you're selling puts, you're generating income without adding any leverage. And then if the price were to ever hit those strike calls, you were going to be a buyer anyway. So that is just one leverage I'd like to see. So my answer to your question is no. I would not like strategy to become all encumbered. Stretch to become all encumbered and become associated with strategy as a whole. I don't want a credit backed Bitcoin backed credit issuer. I want more of what I would see to as the largest Bitcoin accumulator slash hedge fund esque entity. And I don't know yet if strategy has the team to execute this. But we're only comparing to Stretch after maybe a multi-year track record. Stretch is still a toddler. It's like 1 year old. It's still in its infancy. So I'm still going to give management some time, especially because of their thus far successful track record.
Yeah, 100%. And I think or strategies, I'll say this again, 100%. Strategies capital structure is becoming more sophisticated, right? So you have not only MSTR equity, but also you have the converts, you have the preferreds, and let's say the perpetual preferreds, which is Stretch. A lot of these things have complex interactions within themselves. I think Saylor had said in the past that if he could, knowing everything he knows until today, my strategy's capital structure would be basically only equity and Stretch, which I think makes sense, which wouldn't preclude them to do some sort of synthetic yield strategy on top of options, for example. Mark, I fully agree with that. There are other large Bitcoin holders who have been implementing these strategies quite intensively, and I think it makes a ton of sense. As long as I actually wrote a paper about this for those who are interested, as long as you do a very tight risk management, right? So synthetic yield through options is a complex active management strategy. So it is a little bit of a different beast compared to like just managing more passively your capital structure. Maybe that's where the difficulty lies. I mean, it is a little bit of a different realm here, but yeah, I think it would make a ton of sense.
Mark, what do you think the yield will have to be on Stretch for it to hit par again?
So I don't.
Or
11
is
and a
it
half.
even possible?
11 and a half. I think the yield needs to be 11 and a half. I say this because I don't. I think it would more recover on two things. One, cash reserves going back up, as well as BTC price going back up. Um, Saylor, I think strategy has said that for June, for this month, they're going to keep rates steady. And I mean, Michael, at this point, I feel like a strategy watcher in the same way like there's a Fed watcher. I feel like I'm listening to the CEO, I'm listening to Saylor. Are they going to increase rates? Are they going to do
Yeah.
balance sheet control? Like this
Yeah.
is how I kind of feel right now. But I do think 11 and a half would be enough. I mean, I because it's kind of counterintuitive, because a lot of people had issues with Stretch because it was becoming prioritized. And then if you increase your rates, doesn't that mean more of the dividend coverage has to go towards stretch? So it's kind of counterintuitive, but at the end of the day, I still think a Bitcoin recovery price and a cash reserve upping or topping will help close the gap between par.
So you think 11.5, and we'll go back to par.
11, I only say 11.5 because that's what it is right now. And if Bitcoin were to move from 60 something K this week to 90 something K next week, it would probably hit par.
But why though? I mean, just to play devil's advocate here, shouldn't this product sort of shouldn't Bitcoin be almost irrelevant to the price of Bitcoin be irrelevant to this product as it's supposed to hold its peg at 100?
Shouldn't it? Yeah, but I think on this show before, even before this most recent crash, the instrument debuted somewhere last year, end of August, and there were multiple dips off of par. Apart, there's some small ones after the ex-dividend date, but there were geopolitical concerns that made it to cause it to dip. There were now 3 Bitcoin price crashes that caused it to dip. So yeah, in theory it should, but I don't think that with such a large retail holder base that it's necessarily rational decisions going on.
Right.
And then also, this is the first of its kind product. There's nothing else like it from any other issuer. And there was Michael Saylor even admitted that he used over some period of hours, he used AI to help him design this product. So
yeah,
but I think there's an interesting mechanism at play here, because if the Bitcoin price goes up, the amount of strategies Bitcoin reserves, which is ultimately what backs Stretch, it gets more comfortable. So Stretch gets less risky if the Bitcoin price goes up. I think in Mark's scenario, so let's say that Bitcoin magically goes back to the 90K level, what would happen is that MSTR's BTC reserves would go up significantly. Stretch would start to be seen as safer than it is today, and the market would probably start to demand a lower yield. So basically, what would happen at that time is that I think the price of the face value price of Stretch would need to go up, eventually even above 100. And then when it gets to above 100, then MSTR has 2 choices. They can either sell more Stretch, so give more supply to the market, that will help put the price down, or they can lower the yield. But the Bitcoin price going up helps the perception that Stretch is a safer instrument. Does that make sense?
It makes sense, except technically, Stretch is not backed by the Bitcoin reserves, right? It is not collateralized by Bitcoin. So while the perception, I think the mechanism that you're suggesting, which I think is fair, is if Bitcoin goes up, strategy as a whole, as an institution, is a safer institution. It's on sure footing. And if Bitcoin, the price goes up higher, I think the implicit assumption here is that strategy will be able to pay its obligations better. But the mechanism by which it does that is not at all clear, right? At least under Stretch. So if the capital markets are closed to strategy selling Bitcoin, which I think markets right now are saying, based on their small sale on June 1st, that it sort of is, then it becomes interesting and an open question as to how Stretch continues to fund its interest payments. And so that, I think, is why Stretch has dipped. Technically, a price appreciation of Bitcoin should not necessarily impact Stretch, although, of course, I agree it would.
I agree that there's no peg here. There's no automatic mechanism that translates the Bitcoin reserve into the dividend payment. But yeah, that's basically how does MSTR pays the Stretch dividend right now in 2 ways: either by issuing MSTR equity when they're trading above NAV, which is what they did just last week, and then they raised their fiat reserve, or sell Bitcoin, which is something that they haven't been willing to do until the small sale that they did just a few weeks ago. So the price of Bitcoin going up gives them more leeway. And I don't know.
I see that. Okay.
I would be interested in seeing whether MSTR would be willing to sell more Bitcoin and what the impact there on the market would be. Because there's been a lot of confounding factors, right? There's been the MSTR sale, but there's this whole risk off market environment, the AI capital drain. So I think there's a lot more factors playing into this Bitcoin price decline than just the strategy sale. But yeah, I don't know. Right now, everything is very tangled. It's very
So,
hard to read.
so said another way, David. I like that last point. Said another way, if the price of Bitcoin goes up, then strategy has a greater chance to hit a positive MNAV. And if
Yeah.
it has a greater chance of hitting a positive MNAV, if Bitcoin, let's say, goes up to 90K and strategy's cost basis in Bitcoin is about 75K, and it hits a positive MNAV, then it has more of an ability to pay dividends with strategy stock.
Yes.
And therefore, that actually makes sense as a mechanism by which Stretch could appreciate with an appreciating Bitcoin. That makes sense.
Do you all? I was asked this question if strategy should, there was a sale this week and they built cash reserves and bought Bitcoin. Should they buy Stretch to bring it back to par?
That's a great question. So right now, when strategy sells equity, right, on the ATM, I think they have probably a few options, right? So the one thing they could do with that is buy Bitcoin, which they continue to do at very small amounts right now. I think the last purchase was like $15 million. The other thing they can do is increase their fiat reserve, right? So increase their cash cushion, which is what they are doing more aggressively. And then the third thing is retire existing debt. And they could do it at a discount, right? Imagine that if Stretch is trading at $85, they could repurchase whatever they issued at 100 for $85. So that's a 15% discount. They could do this with other instruments too. So they have a lot of flexibility to do. I think it's right for them right now to focus on the fiat reserve and increase this cash cushion. Remember that a lot of this happened but the reason the cash reserves were 2 years of dividend and then they shrank to I think something like 7 months is that strategy decided to use a big part of that cash to retire some preferreds. These are kind of
Convertible debt.
more expensive debt, but it was maturing later on. It didn't carry that much of a cost right now, but they decided to retire some of their debt at a discount. So long term, probably very accretive for shareholders, but it kind of restrains a little bit your cash cushion on the short term. So I don't know. I think what they're doing right now is right. Continue to issue MSTR, increase aggressively the fiat reserve, maybe every once in a while buy some Bitcoin. But I think the increasing fiat reserve part of the strategy should be the focus right now, as they have been what they have been doing.
Yeah, agreed. And if it's any credit towards them, Bitmine, for the audience who are not familiar with them, they are the Ethereum, the ETH version of strategy. They are the largest known public holder of ETH. They're looking to get close to 5%. They have around 4.7% of outstanding ETH. And they actually just announced the launch of their preferred perpetual stock, starting at $80 per share and will have a dividend yield of 9.5%, which I thought was interesting. A lower dividend yield for a more volatile instrument with less annual compounded CAGR, so I don't know. I'm not super interested in this product, but does it help validate strategy's thesis that another institution is launching it?
Yeah, definitely very interesting timing, right? To launch a similar product when the perpetual preferreds are facing their toughest tests. I don't know. I think the rationale behind Bitmine's lower yield is that they are able to extract yield opportunities in ways that strategy cannot, right? So, for example, staking yield, Bitmine, I think, is the largest staker in the market, and they have a big ETH position. So, just from the interest that they can collect from the staked ETH, they would probably be able to fund, I would assume, a big part of those dividends, if not all of it. So maybe that's where the risk profile is different. But yeah, I'm very interested in seeing how that instrument prices and how it trades.
Yeah, I think the interesting part of Bitmine is that they skipped the convertible note stage and they just went right to the preferred. I had actually assumed they were going to go in the same trajectory as strategy and hit the convert market first. I think the fact that they didn't reflects two things. First is that the volatility in Bitmine stock is already sufficient so that they don't need to issue converts at all. But secondly, and maybe the primary reason, is that it's always better for an issuer to issue a preferred that may or may not pay a dividend in the future, rather than issue a convert with binding obligations. So if the market will buy the preferred, you know, issuers are going to issue that all day. And so in some ways, I don't know if it validates strategy's thesis, but what it does is it gets cover. Bitmine gets cover from strategy's thesis, right? It opened the door for Bitmine to issue more favorable instruments to raise capital than a convert for the issuer.
Yeah, I think that makes sense. I think it gets to that point again. Michael Saylor saying, "Hey, if I were to design my capital structure today, knowing everything I know today from scratch, I would probably have just equity and stretch and all these things in the
Of
middle.
course.
They were kind of building blocks toward figuring out the stretch instrument. But there's another interesting aspect here that I think would, if not preclude, probably limit Bitmine's ability to issue a convert, which is the fact that they don't have as much of an options chain or an
Yep.
active options chain as strategy does. This is very important because these convert buyers, they are not credit buyers. They are basically options volatility arbitrageurs. So what they're doing is arbitraging the volatility embedded in the convert with
Yep.
the volatility that they can extract in the listed options market. And this market, I don't think it exists in Bitmine as much as it does with MSTR. So maybe that's one limiting factor. But I fully agree with you. Even if that was not an issue, I think going straight from equity to the preferred instrument is probably the right step.
Yeah, sometimes it helps not to be the first mover.
Right.
Yeah, I mean, like
Um,
you're always going as an issuer, you're always going to prefer to issue preferred over debt. And so to the extent that this works, it's good for Bitmine. I think a very interesting piece, and it's a long topic that we should probably table, but just to comment on what David just said is the development of, or lack thereof, of a options market for Bitmine comparable to strategy, I think is still a story that fascinates me. And I think it's if Bitmine can't develop one as much as strategy has, no one can besides strategy.
I think it's also a matter of market timing. I mean, these things are just so much easier to do in the bull market because you need all this retail flow, right? So, and these things are sometimes hard to harness during
Yeah.
bear markets. If we came back to like a bull market stance, I think we would see a much more active options market around BMNR and things would flow from there. But I don't know. We'll see. We'll see once the bull market catches on again.
Yeah, I mean, maybe it just requires more time, you know?
We're coming up on time there, so I'm gonna call it an end. I want some predictions at the end from both of you all, but before that, for the audience listening, please, we have a guest next week, our first inflection point guest, and it's going to be Hester from the SEC. Her reign, so to speak, is coming to an end. So it will be one of her last podcasts and our first with a guest. So definitely follow and subscribe. So stay tuned to that. And for my predictions that I wanted to ask both of you all, I don't like asking or performing price predictions on any show, but I wanted to ask you all about World Cup predictions. So I'm going to ask each of you Argentina's next game, Michael, and Brazil's next game, David. What do you think the scores are going to be?
So Brazil's next game is Brazil versus Scotland.
Yeah.
Which is tomorrow, and this might be before this gets released. So I might look like a little bit of a clown here. But the interesting thing is that Brazil's team is gonna be very different from the ones that we saw in the first couple of games, because Neymar apparently is coming back. He's playing a position that is not his traditional position. I don't know. I'm actually excited. I think Brazil can do very well against Scotland. So I'm going to call it a 3-0. We'll see.
Nice.
So Argentina's playing Jordan, right?
Yeah.
So I think Messi's going to score at least 2 more goals, maybe 3. Listen, Jordan played a hell of a game last night, but you can just tell a couple of things. One, that team has a lot more development left to do. 2 is Jordan's out of the knockout round. Yeah. So, I don't know how much
motivation.
I don't know how 2 things. One, I don't know how much incentive they have to win. Maybe they do just for pride. But secondly, I don't know how much incentive Argentina has to play Messi or to play their stars.
True.
And so my prediction is couched in the caveat that if Messi plays the whole game, or at least starts the game, I think it's going to be a blowout, but we'll see.
Okay, lovely. Thanks,
Mark,
guys.
No, Mark. England versus Ghana, which is starting in 3
hours. 2.5. Okay.
Definitely already be out when this podcast is published.
Definitely. I'm gonna go with 3-1. Hurricanes on the scoreboard, obviously.
Are you I guess you have to say you're an England fan.
I would just, because I live in this country, I would love it if they won. It would be a nicer place to be during the summer if England won the World Cup and it's coming home. So that's all I'll say on that. But
if Brazil and the US drop off, I will cheer for England. I think it's time. It's been 50 years, 60 years since you.
There's almost nothing that could get me to cheer for England. It was funny. I was listening to a bunch of commentators ask Scottish fans, if you could win this year's World Cup, but the next 3 World Cups would be won by England, would you take that trade? And majority of them said no. They would rather lose this World Cup as long as England does not win the next 3. So I think that was pretty funny.
It is sign of the times. And so if you want to if you don't watch football and you want to find out if we were right, tune into next week's special episode with Hester. But I'm going to leave it there for now. Take it easy and I'll see you all next week.